Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Connie Hill. There's the opening bell. That means the market, at least the cash market, is up and running. Futures market's been a little bit volatile this morning, as we will see here in just a moment. We're going to get into that really quickly here. Welcome to all of you. Thank you for being here, whether you're here for the first time or whether you are a regular here in this discussion. I appreciate the fact that you are here with me as we get into this discussion this morning. If you are here in the live version, be a part of the conversation. I know we've got a very lively chat going this morning. Connie's going to help to facilitate that, though. If you're in the recorded version, please leave us a comment in the comment section. Give us a follow on social media at Ben Watson CS on X, at Connie Hill CS on X. You can also find me on LinkedIn as well. Hope everybody had a great long 3-day weekend. But that creates a little bit more volatility in the market for sure, as does geopolitical risk, as does everything, right? So let's take a look really quickly at a couple of quick housekeeping items, and we'll jump right into what's going on here in the market this morning. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice. Remember that futures and futures options trading is not suitable for all investors. It involves substantial risk. It's a highly leveraged environment. Make sure that you read the risk disclosure statement for futures and options. Make sure that you understand that when you trade something like a cryptocurrency futures, remember that those virtual currency futures have some specific risks associated with them. They are not legal tender. They are storehouses of value. Make sure that you are aware of and read the CFTC and NFA customer and investor guides for those products, and that is something that you want to pay attention to, as that becomes a greater part of some traders' focus in the market is looking into those cryptocurrencies. We're going to take a look at those here this morning. Also, remember that futures margin is known as a performance bond. It's the amount of money you're required to deposit in a futures account to establish and maintain a futures position. That's a little bit different than trading an equity. It's a little bit different than trading an option where you're paying for or receiving a premium. The futures margin is putting up that performance bond to enter a position. We'll talk a little bit about that as we get into this discussion today. Remember that as we do this, that there is there are certain risks and certain things that impact the market, including, when we talk about things like energy markets or metals markets. Some of the things that may impact the market are increases or decreases in those margin requirements brought about by the exchanges. So we'll talk through that as well. Now, we're going to be using the thinkorswim desktop software platform here this morning, specifically the paper money version. That is a great learning environment. It is not a guarantee of future success. And in fact, the paper money version of the thinkorswim platform, desktop software platform, does not do certain things that a live trading account would do. So just be aware of that. I'll try to point those out as we go along in this discussion. We're also going to use some technical analysis. It's only one way to look at the market. It is not by any means a guarantee. It is theoretical in nature, as are all methods of looking at the market. So be aware of that Charles Schwab does not recommend the use of technical analysis as sole means of investment research. Now, one thing I want to talk about here really quickly, this question came up specifically in the chat this morning. Is the question of stop orders regarding futures contracts, futures positions. Stop orders are not guaranteed an execution due to exchange rules, not Schwab rules, but exchange rules based on certain conditions. The exchange may reject an order. They may substitute an exchange designated limit order for an originally triggered market order. So stop order that generates a market order that theoretically should grab the next available price in the event of a fast-moving market. That order is going to be worked. It's going to be substituted by the exchange as a limit order. That limit order is going to fall within what's referred to as a protection range. If the market moves outside of that protection range, then that order may be rejected. It may not fill. The price may move far beyond that range. So it's treated much like a limit order would be if we were looking at an equity or an option trade, and a stop on those products. But the range of that limit is designated by the exchange, and it widens when there's more volatility, and it may narrow when there is less volatility, just to protect not only the exchange, but also the trader in that circumstance. We'll take a look at some of those characteristics here, and I'll show you where you can find more information about those protection ranges as we get into this discussion this morning. So let's do this. Let's pop over here to the thinkorswim desktop software platform. The market's up and moving this morning. Taking a look at, first of all, the /ES, and starting to see that move to the downside here. A little bit of geopolitical risk, certainly some geopolitical economic risk at play. We're seeing the Japanese bond market seeing some unprecedented, not necessarily unprecedented ever, but unprecedented in recent, I'm saying the last 2 or 3 years history in terms of bond price movement. That bond price movement is likely impacting a lot of things that maybe we're not considering. Things like metals markets, things like the US dollar market, certainly things like the /ES. Geopolitical instability overall seems to be, at least at this particular point, one of the factors at work here in the /ES pulling back a little bit, kind of as that measure of the broad market, if you will. The NASDAQ, kind of that technology heavy segment of the market, seeing a break below the 50-period simple moving average here this morning in the futures market. So the futures across the board, at least S&P 500 and NASDAQ futures down. The Russell 2000 futures, the small cap futures down, but this is a different picture than what we've seen, and it's a different picture than what we've been seeing in the other two primary indexes here. Is the small caps have been on a pretty good tear, and you've had 1, 2, 3, 4, 5, 6, 7 kind of candles in a row that have been upward moving candles, and then we see this little bit of a pullback into a hammer candle. So there's some buying pressure coming in off of that little bit of a downward movement, but nowhere near the 50-period moving average, which is interesting for the Russell 2000 because it has been using that 50-period as a level of support a number of times here in the last couple of months, bouncing off of the 50, bouncing off of the 50, now making this run to the upside. Now, could it pull back? Yes. Could it continue to pull back? Absolutely. So that little bit of a pullback here kind of impacting the market. While we're looking at this really quickly, while we're on this particular grid, I'm just going to plug in a couple of other areas, and we're going to kind of scroll through and see what's going on here in the market that may be impacted by this overall movement to the downside, at least in equity futures, equity index futures. So let's take a look at /GC. This is gold. And you can see what's going on with the gold futures here this morning as the market gets up and running, and as we get off of this 3-day holiday weekend. Gold futures up about 3%, up 146 points at the moment, breaking out perhaps of a little bit of a resistance level. So gold futures on the move this morning, as is, I think, we've had this conversation about gold as kind of a safe haven perspective. Why is there this rotation into gold? Because gold has, in and of itself, has intrinsic value, but from a futures perspective, it oftentimes becomes, and it's not a guarantee that it will be or that it will continue to be, but it oftentimes for investors becomes a perspective of this is that safe haven play. or that safe haven trade, that when everything else is becoming more volatile, gold becomes the safety measure. Now, I'm saying that because that's the perception. Gold could reverse. We could see changes in gold, certainly the same way that we would see a pullback in anything else. Just calling something a safe haven does not mean that it is safe and that it is without risk, because there is risk here for sure. Let's take a look at /SI. As Gary points out, silver up almost actually 7 points, a little bit, 7% this morning, kind of bouncing back between 6.9 and 7.1 this morning. And from a long-term perspective, that looks like a pretty good bull flag. I know Connie has taught that bull flag class. We talked a little bit about this last Tuesday in terms of looking at price patterns. Rally up, pullback, rally up, pullback, rally, starting to rally up and really kind of gaining some traction here, but fading just a little bit, as is the case with pretty much anytime you see a breakout move. There is some fading of that move, meaning sellers coming in and picking off some of those higher prices. Higher prices are met by selling pressure. And that's what I think maybe we're seeing a little bit of here first and foremost this morning in the silver futures. Now, one thing I happen to notice both in gold and here in silver futures in this longer term chart, this is a 1-year daily chart. I'm going to grab my line tool here. I've got the RSI, the Relative Strength Index, and this is just kind of a straight out of the box sentiment and momentum indicator. And what I'm happening to notice here from that sentiment perspective, and really kind of from a momentum perspective, is the fact that there is a little bit of a bearish divergence going on, even though RSI is moving higher, right? Even though this line on that Relative Strength Index is printing higher. Look at where it was here when gold back at the end of December, rolling into the end of the year, was giving us this rally and then this big bearish engulfing. You see where momentum was. It was up towards that extreme. Now it's pulled back a little bit. That RSI has rolled down a little bit. We saw that rally back up to the upside, and now we're starting to see this breakout, but at a lower high on the sentiment indicator. That lower high on the sentiment indicator, this bearish divergence could potentially, from a technical analysis perspective, suggest that there is a bit of coasting higher going on, that it's not being driven higher. And what might be an indication of silver prices being driven higher by that technical pressure to the upside would perhaps be a break either out of this diagonal trend line to the upside on the RSI, or a new higher high relative to this most recent higher high on the RSI. We're not there yet. Now, here's the thing to keep in mind. The RSI is a lagging indicator. So this little lower high right here is very likely reflective of this move going on here. But remember what the RSI calculates, right? What the RSI is calculating is the idea that where is that candle closing relative to its highs or lows. And both of these candles here are closing, even though they're down candles, even though they're red candles, they are closing closer to their highs than they are to their lows. Maybe this one is kind of in the middle at this particular point. So each one of these candles still is closing closer to their highs. So what this suggests perhaps is that there is a little bit of lag and maybe a little bit of coasting higher here in terms of this move to the upside. Now, Stay Gold asks the question, if an investor were looking at shorting or fading silver or gold at this point, would you look at volume as well? And I think, volume is one thing to think about. Commitment of traders and perhaps the momentum in a particular direction is something else to think about. So while we are here on gold and silver, before we get into a couple of other trades, and I want to talk through a couple of things, I want to go back to that gold chart /GC really quickly. And in fact, you can see the bearish divergence here. If we go to /MGC, This is the micro gold futures, the one that we've been talking about, I think, most recently. And I was putting together a trade here this morning, and I'll talk about that in just a minute. But you can see what's going on in the micro gold futures contract is that that's breaking out, still now breaking above that RSI level. This is maybe doing it with a little bit more bullishness, right? A little bit more bullishness. It's not yet at that same high. So there is still a bit of a bearish divergence, but it's breaking to a new recent high on the RSI. That suggests that maybe it's gaining some traction this morning, more so than silver is. What's interesting, remember, we've talked about this before, the difference between silver and gold. The difference between silver and gold is that gold, while it has intrinsic value, while it has kind of numismatic value, while it has that jewelry value, it has sentimental value, it has, kind of that alternative safe haven value to it. Silver has some of that kind of intrinsic value to it, but it has much more of an industrial perspective, especially in the AI space, especially in power, in batteries, in solar, all of that stuff, all of that industrial in terms of technology. Two things going on. Gold tends to be held on to. Silver, because of its industrial component, tends to be consumed, meaning some of the processes that silver is used for on an industrial basis tends to consume that silver, whereas gold tends to sit in vaults and safes and things like that. Silver, on the other hand, that supply gets consumed because it gets turned into other things and turned chemically into other things. So there is kind of a supply destruction perspective to that. The other thing to think about is if we go back over here to these other indices, the S&P 500, and specifically this one right here, the NASDAQ, which is tech heavy, if that's rotating down, that would suggest that maybe there's a little bit of, at least from an investor perspective, backing off from that silver consumption perspective, which is maybe why we're seeing less traction on silver, even though percentage-wise, it's got a bigger percentage gain than gold. Why we're seeing perhaps a bit more of a bearish divergence in momentum on silver than we are on gold. Now, what I want to look at here really quickly, and I'm going to pop over here to a report. So I'm going to pop over to the Commitment of Traders report. This is the CFTC, the Commodity Futures Trading Commission. Third-party provider of information. You notice right up here at the top, it says an official website of the United States government. This is the CFTC. So this is not Schwab data. This is a report that is compiled on a weekly basis by the CFTC. This is the Commitment of Traders report. And the Commitment of Traders report does some interesting things. Now, again, third-party data. This is not the opinion of Charles Schwab. This is simply third-party data. So take it for what it is. There is no endorsement of this information. There is no advice in this information. So what I'm going to do is I'm going to come down here to the weekly COT, the Commitment of Traders report. Okay. And I'm going to come down here to metals and other. Now, we've got agriculture, petroleum, natural gas, electricity. You've got financials, those types of things, right? So all of that gets broken down. So what I'm going to do is I'm going to come over here to the short format metals and other. Now, this is what we're going to look at. We're going to look at the short format. We could spend weeks talking about this, but I'm just going to break this down really quickly. And again, this is not a recommendation or an endorsement of this information. So I'm going to go to the short form CFTC Commitment of Traders report. And so what this is doing is it's breaking the market down into the different segments of the market. Producers, meaning those that are utilizing whatever that instrument is in the futures contract, whatever the contract settles to. In this case of metals, it would be settling to a certain amount of bullion. It's also going to break it down into swap dealers, those financial exchanges and so forth. It's going to break it down into managed money, institutional traders, speculators. Other reportables is generally retail. So what I'm going to do is I'm going to scroll down here, and you see the name of whatever the product is. So here's silver. So this is silver. Now it's got the silver contract. It's got the micro contract. The one that we've been looking at is that micro 1,000-ounce contract. So this is that micro contract. Because this is a micro contract, it's not accumulated in this CFTC Commitment of Traders report, at least not for silver. But you can see that silver, if we look at the large contract, the 5,000-ounce contract, the big contract /SI, that contract, if we look at long and short, so each one of these groups is broken down into long and short, long and short, long and short. So how many contracts are long? How many contracts are short positions? Remember, long expects the price of whatever the instrument is to go up. Short expects whatever that instrument is to go down. Look at where the contract disparity is. At least right now in the producers, it is on the short side. There are more open contracts on the short side. Again, one of the reasons why maybe we're seeing a little bit of that testing higher, and maybe there's a little bit of coasting there. Now, on the other side of that coin, you look at managed money. That is the institutional side. Lots of longs. You look at retail, those speculators, lots of longs versus shorts. So the manufacturers are shorting it. The industrial users are shorting it, but the managed money, the retail and institutions going long. Now, again, not a guarantee that it's going to drive a direction. This can give us some context to what's going on. Now, let's go back up to that, or down to that gold contract. Here's the one that we've been talking about, right? And the micro gold contract that we've been talking about. Not a lot on the edge of the producers or users in that gold space, but swap dealers, the financial brokers, long contracts, the managed money, long gold contracts, retail, long, but more on the short side. So there's a little bit of, at least today, shorting, or at least over the course of the last week, shorting into some of that. Let's look at the big contract. This is the 100 troy ounce, not the 1 ounce contract, or the 10 troy ounce contract. So long versus short, some long, a little bit of short on the producer side. Lots of longs on the financial side, but a heck of a lot of shorts there. Now, on the managed money or the institutional side, this is where kind of that safe haven perspective. Lots of longs on the institutional side, not as many shorts. And on the retail side, lots of longs, not as many shorts. So there is some of that accumulation going on in the retail and institutional side, at least in the gold contracts. If we come down, you can see that there are others. There's the 1 troy ounce contract, that micro contract that we've been talking about. Here's copper, the fair short position in copper going on at the moment. And you see some others that we don't have access to via the exchanges, but those are mostly industrial. So you've got aluminum. Somebody was asking me about aluminum the other day as well. So that's some information that can be helpful to add context, but don't get too wrapped around the axle around it, about that as well. So let's pop back over here and see what's going on in a couple of these positions. So that's our gold futures contract. So what I want to do is I want to pop over here and change our grid really quickly to our futures movers grid. There's our silver contract that's moving up. I want to take a look at that gold contract first really quickly here, /MGC. And that's weekly, Hans, is you get that CFTC Commitment of Traders report. All right. So so that's what we're going to get to here, Koala, is how do you square this? At the end of the day, what matters is what price is doing. Price is still king. The CFTC Commitment of Traders report gives you some context, but it does not guarantee trend direction. So that's a good way to think about it. So I'm going to put these back. We'll restore these cells so that we can see both of these. This was the trade that I actually tried to put on earlier this morning on /MGC, seeing that breakout move today with some strong momentum. So I want to pop over here to this right-hand side really quickly. And this is the trade that I was looking at. Now, here's what happened. I didn't have enough margin capital in this particular paper trading account to place the trade. Those trades got rejected when I put the trade on. But I want to break this trade down a little bit so that you can see what potentially could have or would possibly, again, have happened in this scenario. So I saw it moving right about here was when I started to look at this and started to put this trade together. So I put in and created, even though it got rejected, I created an order which was a buy stop order here at 47.40. So buy stop, wait, don't do anything until the price of this futures contract breaks through that resistance level, evidence that it's moving higher. That would be the entry into the trade. In fact, I labeled it as the entry into the trade. The stop that I put on was based on what I was seeing earlier and before I got to this little pullback right here. But that stop was right here at about the 47.28 or 47.27 level was where I was putting on that stop, taking the trade off if it started to go against me in this particular case. So much like we've done before, shorter term trade, intraday candles. These are 5-minute candles. This is an intraday chart. And then I put a target on this trade as I put the trade together. And again, remember it got rejected, but I put this target on the trade up here at around 47.72. And I based that on this idea, flagpole, right? Remember what a flag pattern trade looks like, a bull flag trade. Rally up, pull back, rally up. And this distance should potentially equal this distance. That's what technical analysis suggests, is that those two distances are going to be equal. So what I did is I measured this distance right here. Now, I could have come way down here because that was within the realm of this move. But I wanted to be a little bit less aggressive here. I wanted to attenuate those expectations. So I took the first major support bounce in this rally, and I used that as the measurement of the flagpole. That was this distance right here. So we'll call that X, right? So this was distance X. And then I just duplicated it up here on that resistance breakout, the bull flag breakout, and our expectation should have been distance X as well. So this would have been distance X, and that's what took us up to that potential target right there. That's just a simple, straightforward bull flag type of trade. No guarantees that it's going to do that. Technical analysis doesn't guarantee that, but that's kind of the measurement objective that helps to set an expectation where there might be resistance. Do we have to take the trade off at that point? No. It's a short-term trade, so we could set a target there. We could set an alert. We've talked about some of the ways that we could manage this type of trade in that perspective. Now, what happened when I put that trade on is that trade rejected, and I'll tell you why. So I come back over here and I said, wait a second, why did that order reject on me? Why couldn't I place that trade in this particular account? Because as I look at this trade, and again, remember, this is my paper trading account. This is a simulation. This is not a guarantee, and I'm not doing this for advice purposes or recommendations or anything else. And then I happen to notice right here that my futures balance is in the deficit. And even though I've got cash in my equities buying power, my options buying power, my net liquidity in this, or liquidating value in this account is substantial. My futures balance, which is separate in this particular case, was in the deficit. So I can't initiate a new trade. And I'm thinking, wait a second, why am I so short of buying power here in this futures trade and this futures account? And then I remembered that if we go to the monitor tab, here's what I've got. Let me pop this back to our margin account really quick. And I remembered that, number one, I'm short a /MES, which has, if we go back to our, let's click right there. We go back to our trade account. We know that that's tying up about $4,000 of margin, right? That's the maintenance margin now to hold that position. Now, that's working in our favor. Because remember, we did that trade. We went short the /MES, the S&P 500 E-mini micro contract, to hedge off some of the risk in this long stock portfolio. But you got to remember, that's going to tie up some of that margin requirement and that margin capability. So I've got some margin being tied up there. If I come down here into these other groups, into my futures group, I remember, wow, I've got this calendar spread on that we've had on for a while, which is tying up margin. And then I've got another calendar spread, which is tying up even more margin. So as I'm doing that, I'm realizing, oh, okay, there's one of the reasons why I'm not able to initiate this new trade, because of what I'm already trading. And some of you might have run into this scenario that you end up having a lot of positions on, and you don't have the capital available to initiate a new position. So what do? Well, you either transfer money in. This is what results sometimes in a margin call when your account goes into that deficit and there's not enough capital in the account to satisfy the margin requirement, that maintenance margin requirement. And very likely you'd get a call from the margin desk saying, what do you want to do? Liquidate positions or add capital. And so since this is a paper money account, I did not get that call from the paper margin account margin desk. So I got to deal with this on my own. So what I have to do then is look at liquidating some of these positions. So I want to talk through a couple of these scenarios here. So we've already seen what's going on with the /MES. We are short the front month. And thanks, James. Appreciate you coming. We are short that front month contract, the one that expires in 59 days. We are long the back month contract. So we expect the /MES, the S&P 500, to rise in the future. We expect it to come down in the present time. That's the trade that we were looking at. We're really looking at the width of, so remember what we're doing in this calendar spread, and I'm not going to spend too long talking about this because we've spent a fair amount, is we're trading the difference. We want this calendar spread. We want this price to go down, and we want this price to go up. So we want these two to narrow. They are not narrowing, or at least they were not narrowing this morning when I was looking at this. We want these two prices to get closer together, not wider apart. So we were expecting, that's why we sold the front month and we were long the back month, right? Sold the front month, long the back month. We wanted that spread to narrow. And that spread in this case is not narrowing. It's in fact widening out a little bit. So that's working against us. So what we could do is we could close this calendar spread down at this point, and that would free up potentially some margin in this particular account. Now, the other one that we've got, we're expecting that crude is going to rise in the near term and fall in the back month, fall further out in time. We're expecting this spread to widen. And unfortunately, this spread is not widening as much as I would like it to. It's been working a little bit today, but you notice what's been going on in this spread. So let's do this. Let's close our /MES trade first, this calendar spread first. So I'm going to right click and we're going to create a closing order. So we're going to sell this. We bought it originally to begin with. We're going to sell this calendar. We're just going to eliminate this calendar spread. We bought it originally at about 53 points. It's now trading at 103. So kind of worked a little bit in our favor here. Let's see if we can close this trade down. What that means in this particular case, and not rolling it, but what that means is we're buying back the one that we're short, and we are selling back the one that we are long. Okay. And we're going to go ahead and click on confirm and send. We're going to read through this order, and we're going to fire that order off. And again, this is a closing order. No, it's not. Okay. So I may not be able to, I may have to leg out of this position in this particular case to close this down. So I'm going to close the one that I'm short. We're going to create a closing order. We're going to buy back the one that we are short. Click on confirm and send. Read through that order, make sure that's what we want to do, and it's not letting me do anything at this point. Okay, so we've got to deal with that, right? So this may be a function of this paper money account as well, that it's not letting me close those open positions. Let's see if we can create a closing order, and let's see if we can sell that one back. And if it'll let us do that one, and it's not letting us do that one either. All right. Nevertheless, that may be a function of this account. So I gotta perhaps look a little bit deeper into this account, but that's what potentially can happen. So what I want to do really quick while we're looking at this, now that we've got that gold trade, that expectation was that move to the upside. Momentum seems to be waning a little bit. Yeah, and Mike, that's always a good question. When we talk about things like equities, when we talk about options, closing the short side is the prudent way to do that first, as opposed to closing long side and being left with a naked short. But remember, shorting in a futures contract is a little bit different than shorting an equity or shorting an option. It kind of has that equal directional idea to a long futures position. Remember, that's one of the things we talked about last week, is one of the potential, not making a recommendation here about using a particular instrument or a particular direction, but shorting a futures contract, going short the futures contract to trade that directional movement is perhaps easier from a directional standpoint than it is shorting a stock. And it doesn't create that obligation that shorting an option does, or creating a naked short option position. It's simply taking that directional position. Now, that doesn't mean that it can't keep going down, and we think about it having equal risk to going up. But it's always a good idea, and again, getting in the habit of closing the short side first and then closing the long side. I like that methodology and kind of that reminder there. All right, so looking at going long in this particular case, gold, which we weren't able to do, but that was the trade setup. Let's take a look at /M, SIL, /SIL, and silver was kind of doing the same thing, but it is not breaking back up in that upward direction. And if we pop back over here to this particular chart, you can see some of that fading that's happening here on the top side, that maybe that's being sold into a little bit here. Let's go to copper, /M, HG, micro copper contract. And copper back down again, as we see kind of that industrial perspective, copper is getting sold off back down to these lows. Now, there is, from a longer term perspective, the idea perhaps that if copper is getting sold off, that there would be potentially an opportunity to enter a long position on a possible bounce off of a support level. Because the underlying instrument, the underlying perspective of copper is the idea that just because we have geopolitical instability right now doesn't mean that we don't have a deficit of power producing infrastructure here in the US. So I think there's an underlying possible, and I think what we're seeing is that underlying long bid on copper, right? With that possibility of a bounce. But what might we look for in this particular case for an entry into a long copper position? This might be a scenario where maybe that close above the high of the low day comes into play. So if this is our low day right here, which is right now, then closing above that level would be right up here, wherever that high was. If that high is maintained for the day, then that might be the threshold for getting into the trade. So let me pop this in with the tag here. And again, this might be an entry based on that close above the high of the low day. Some traders may use this level as a stop position, and then a target may or may not be put on this. And I would agree, it's very likely, Jay Richardson, going to be bumpy until that geopolitical risk gets resolved. Let's take a look at a couple of other areas really quickly here while we're just looking at these spaces. /BTC. This is Bitcoin. Remember, we talked a little bit about that. Bitcoin getting sold off just a little bit. So something to pay attention to. Again, keeping in mind those risks of cryptocurrency futures contracts. /10Y, which is the 10-year yield. That means if this is going up, bond prices are going down. If bond prices are going down, that means not many traders are buying bonds, and so they have to raise the rate. That's how that mechanism works. They raise the rate to make those bond purchases more attractive. It's an inverse relationship. And we're seeing, because this is maybe some bleed over from that Japanese bond auction, that 20-year Japanese bond auction last week that was very anemic. Prices skyrocketed. This may be some contagion there from that particular perspective. Let's take a look at, I like that idea. Let's take a look at VIX futures and see what VIX futures are doing here. And VIX futures, and again, this is a one-day chart, but we can see VIX. And this is, I think, again, we go back a couple of years and we look at that yen carry trade unwind, and we saw what that did to the U.S. Volatility market. We can see some echoes coming here in this VIX move to the upside. Yeah, and I think you're right, Kelly. I mean, I think from this standpoint, this is reflective of kind of that overall geopolitical risk. Lots of stuff going on today. So to answer Staygold's question, pop right here to the drop down, go to the futures tab. And if you scroll through this list, you're going to see we've got Japanese yen futures. Let's take a look at what Japanese yen futures are doing. They are up, but down just a little bit here. And I think do we have Nikkei? We've got micro yen futures. We have, in this case, Swiss franc, silver. Let's see, scrolling on down here. In our list, we do not have Nikkei futures, index futures. No, we do, right there. /NKD. And those are dropping much like, you notice how much these replicate what's going on with the S&P 500. S&P 500 moving down. This is moving those Japanese stocks as well. So that's how you might trade that Nikkei in these futures contracts. But it's always a good idea to pay attention to, as that volatility increases, what that margin requirement is. So that's something to pay attention to. In fact, while we're talking about that, notice the /SIL contract, that micro futures contract for silver, or the 1,000 ounce instead of the 5,000 ounce. Notice what that initial margin has gone to. Remember when we started putting trades on it a couple of months ago, it was currently sitting at about $2,500 initial margin. It's now at $8,700. In fact, last week when we talked about it in this class, it was at $7,500. So initial margin has gone up on silver, reflective of volatility. All right, if you want to learn more about all of this stuff, come on over here to the futures landing page at Schwab, schwab.com/futures. If you want to learn more about specific things that we've talked about or specific ideas, come on over here to Trader Talks, youtube.com @Trader Talks webcast. Make sure you click on subscribe and follow along. Make sure that you do that. And you also click on the like button today if you happen to enjoy this particular content that we've talked about. Lots of stuff going on. We're going to be talking about it all day long, I'm sure, in other venues and other webcasts as well. Guys, thank you so much. My thanks to Connie. Yeah, keep your arms and hands inside the ride at all times, guys, because it is going to be a bumpy ride. Thanks to Connie for helping out. Thanks to our great production team. And last but not least, by any means, our great reviewers, Nikki and Mindy and everybody else that helps out with that. So thanks for doing that. We'll see you soon. Take care, everybody. Bye-bye.